Okay, it's time to get started. Again, my name is Adam Goldstein. I'm the Chief Business Officer at the Federal Home Loan Bank of New York, and we'd like to welcome you to today's session. During the session, if you have any questions, please submit them at any time through the question box, and we will answer them at the end. Special note, we just want to remind you that our final webinar of the year is coming up next week, which is an exciting fireside chat with our President and CEO, Jose Gonzalez, which is Thursday, December 10th at 11 a.m. We'll preview the co-op's performance in 2020, discuss the challenges and opportunities in the year ahead. When you register for that webinar, you'll actually have an opportunity to punch in questions that we will work into the live webinar, and we certainly hope you can join us for that. Also want to just say thank you for all those that voted, and by voted I mean in the Federal Home Loan Bank of New York's 2020 director election. The results were announced last month. Our board is so important to the operations of the bank. They're active and engaged, and we benefit tremendously from the director's guidance and insights and experiences. I want to congratulate New York member Director Ken Mann from the CEO of Dime Community Bank, and Steve Romaine, the chairman of Tompkins Trust Company, on their re-elections, and then incoming New Jersey member Director Tom Kemley, president of Columbia Bank, on his election. We'd also like to congratulate Chad Kilborn on his re-election as an independent director, and we're excited to add retired U.S. Navy Rear Admiral Danella Barrett as an independent director. Very exciting to have her on our board as well. We seek to add value to membership by bringing thought leaders and educators and strategic partners together like we're doing today. We encourage you to also visit our website on the Financial Intelligence Library, where you can talk about, you can listen to podcasts on our LIBOR SOFR transition, which has gained activity on our website recently with the announcement to potentially delay the LIBOR SOFR transition. We've been working with our members to set up transition offices. If you haven't done that yet, we'll be happy to chat with you. You'll see lots of publications, our member service desk weekly, PPP loans as collateral, our disaster relief efforts that we have, letters of credit changes, tons of good stuff up there. Our economic intel is pretty good from our financial economist, Brian Jones, who you've heard before. We got lots of good feedback on that. But for today's session, we're really talking with Tommy Warren today from Vining Sparks to discuss the current environment, and he's going to offer some strategies to help us get ready for 2021. And I'm sure, like all of us, we cannot wait for this year to get over so we can get into the new year. And to kick us off with that endeavor, I'm going to ask Tom Citino, our Vice President and Director of Member Relations, to introduce Tommy and tell us what's ahead. So, Tom?
Sure. Thanks, Adam. Good morning, everyone. Welcome to the session. So I want to welcome Tommy Warren from Vining Sparks, Interest Rate Products Group. He's a great guy. We met a few years back when we did an asset liability management member education program up in the Utica area. Tommy did a great program, and we remained friends throughout the last couple of years. But to give a little background of Tommy, Tommy has been working with Vining Sparks just for a few years, since May of 2017, and he's the SVP of Sales and Business Development. His areas of expertise, like I mentioned, is asset liability management. He's got a lot of great ideas on investment portfolio management, optimization of liquidity, and also derivative products strategies, and he'll get into a lot of that discussion today. Prior to Tommy joining Vining Sparks, he's had a long career in the banking and financial services world. He's worked for a number of, as CFO for numerous financial institutions in Georgia and South Carolina. This included community banks, savings and loans, and credit unions. And then lastly, he was heading up a de novo bank in Greenville, South Carolina. That opened in 2006, and then it had been acquired in 2016, and then Tommy moved on to Vining Sparks. So I think we're going to have a great program, and I know you'll appreciate a lot of Tommy's insights. So with that, I'm going to turn it over to Tommy Warren. So Tom, take it away.
Thank you, Tom and Adam. I appreciate that, and I would just say we appreciate this opportunity to talk with those of you in a little farther north. You will notice that from my accent, it doesn't take long to know I'm not from the New York, New Jersey area. But I do love living in South Carolina, although last night we got into our lows were in the high 20s. So I felt like maybe I was a little closer to your part of the world. But we do appreciate this chance to visit with you and hope that you'll get some, at least a nugget or two out of this presentation. So moving right along, I'm just going to hit real quick our agenda. We're going to talk about the environment, some tactical things that maybe take a little less time, and then focus on just strategies of things that we think are important for success. The interest rate swap, you're going to get the access to these slides later. We're not going to spend much time on it, but it's there for just information for you to look at after the fact. So with that, we'll get moving. And I'm going to start with this very busy chart. But if I was better at animation, I would have it slide through over 2 or 3. But just to get started, let's look at it. And I want to talk about how this originated. I was actually listening to a webinar just 2 or 3 months ago, and I heard speakers say, well, we've been in a low rate environment before. We know how to deal with that. Let's just move on and talk about other things. And being the Southern gentleman that I am, I typed in a question and politely disagreed and said, I don't think we've been in this environment before. And it kind of started a little bit. He answered me. And so we started kind of doing some research, and this developed over a couple of weeks of discussion. And so first I'll start with the blue line in the middle. And that's kind of the average for the last 20 years of the 210 slope. Now we tend to use the LIBOR yield slope 210, but Treasury slope would be virtually the same. And so you see our average slope has been just under 130 basis points for the last 20 years. Then we've laid on top of that the blue line, which is period of time, the actual slope for that period of time. So if you go back to the early 2000s, we generally were in a high slope environment. Then 05, 06, we went to lower slope. During the financial crisis, and this is extremely important, we were in a relatively high, at least average at all times, but generally high slope. And then since about 2016 have been trending down with a slight uptick in the last few months. We're up in the 80 basis point, 70 basis point area today. At the time we did this, we had a slope of about 60, and it's gone up a few basis points since then, with the 10-year being in the low 90s. So we start off with slope, and why is that important? Is because community financial institutions, that's how we make money. We live off the slope. Our business, we basically buy money short and sell money long and try to make enough money on the difference to cover our overhead and make some money. So those longer, typically higher slopes are very important for us and generally better for our earnings. So that's one part of the equation. The second part, and as that speaker mentioned, is we're in a low rate environment. And so we plotted on here in the gold just the Fed funds rates for the same 20-year period. And what we see for the most part is what I would call a mirror image. If slope was high, short-term rates tended to be low, and vice versa. And frankly, a low slope environment's not great for us. In my opinion, a low yield, low slope environment is kind of the worst of all worlds. So where I had problems with that previous speaker was we look at 09 to 15 during the financial crisis, we did have short-term rates that were zero-based rates, but we generally had very good slope. So we could still make the buck and the traditional ways. As you look to the right, what we now have is the combination of a lower slope and lower rates. So all of these are facts. Why does that really matter? Well, we think, as you have experienced in the third quarter results were just came out from the FDIC yesterday, and they used the word that has been used so much during 2020 of unprecedented. And so they said we had an unprecedented industry decline in net interest margin. Well, why is that? If you look at, we all know our balance sheets don't change overnight. We've had a number of years where slope has been declining. It doesn't happen instantly for us that our margins, but we've been declining. Well, what happened in 2020 was a combination of the slope declining and hitting these low rate environments. We think this is important for your board, for your ALCO, for your management team to understand. You probably have already prepared or are preparing your budget, and I'll be surprised if many of you or any of you are expecting an increase in your margin from 2020. When your directors or other members of your team ask why, I think this chart explains it. You can't outlend your environment. And this is the environment we have today of a very low yield, low slope, and those combinations are creating an unprecedented experience for us in the community institution world. We've gone on so far to say is we think there's none of us, and as Tom and Adam mentioned, I've been at this quite a while. And so I've seen a lot of different rate environments. When I started out, we were dealing with primes in the 15 to 18%. I can say none of us in our lifetimes have seen this combination, a zero rate environment with a very flat yield curve. It is truly unprecedented what we're facing. And so what does that mean? It means that if the old times aren't here, we can't use the same old tools. So what I hope to present in here is maybe some new thoughts and some new tools that may help you during these difficult times. The other realization we have is virtually every dollar that comes back to us from our assets, whether it be our investment portfolio alone, we are doing one of two things. It's sitting in cash or we're reinvesting in lower yields. So from what we have done today, everything is going to be pushing our rates and yields lower. And margins are just now being impacted. We've seen from the FDIC that we had a huge decline. Well, it's going to continue in all likelihood through 2021. So with all that positive news and encouragement as a starting point, let's look and see if we have some thoughts for where we might be and things we might can do. So just to finish up where we are today, deposits have surged. Virtually everyone, there may be a few exceptions out there, have record cash levels. And what we're facing besides lack of good options to invest is the loans that we did make in the last 6 months or 9 months are probably PPP loans that are going to be repaid or forgiven soon. That's going to add to our liquidity. And we hear nationwide that lending opportunities are diminishing. It tends to be that what we're doing on the lending side is refinancing our own loans, or we are buying other loans from other banks at lower rates. And at the same time, volatility is increased. So all of that lays the current framework of where we are. So let's move and let's start talking about what are some potential solutions for us as we start dealing with 2021 and our options. So first, some tactical thoughts. And I would just say modeling. We need to turn our ALCO into a profit center and model different options aggressively. So we need to be looking, and I know a lot, the investment market isn't out there, isn't overly appealing, but we need to be determining what is the cost of keeping all the excess liquidity that we have. Yes, it protects our mark-to-market value, but we are losing earnings, and we need to be modeling some impacts of those. Where can we invest? And we would say invest in the steepest yield curve. What do I mean by that? Not all yield curves are created equal. The Treasury and swap curves tend to be on top of each other, but the MBS CMO curve is different. It widens and narrows. The muni yield curve changes over time. So we need to be constantly impacted or looking at where is the best yield curve for us to invest. I know your regulators require, and understandably so, you to be using a static balance sheet, using rate shocks of up to 400 basis points. We would suggest that that is very important. You need to do that, but really use your ALCO for how you manage your bank. Look at your strategies against your existing balance sheet and how you expect it to change, and go to smaller, go to 50 or 100 and say, we think these are reasonable changes. How do I protect myself? How do I look, invest, and consider options? At Vining Sparks, we have a tool called the Performance Architect, and I'm not here to push that, but you can run multiple scenarios and say, what if we do this and we fund it this way? What if we use our cash in these kind of investments or loans, or we purchase some loans, whatever it might be, and that it shows impacts on both our earnings and our risk, our EVE, earnings at risk, all of those kind of things over multiple years. We think you need to be doing that. Look at different points of the yield curve. Our funding tends to be shorter points of the yield curve, securities kind of in the middle, loans longer. We need to look at different points of the yield curve, how they may be changing over time. We think as we do all of this, especially as we look at a changing balance sheet and you start deploying your excess cash, maybe you're not as interest sensitive as you think you are. Most of our banks that we talk to do that. Well, when you're sitting with a unusual percentage of cash that will reprice immediately, then your life chances are you will be more interest sensitive. If you start deploying that or it runs off in any sense, you're not, I think most of you are not planning to still have the same percentage of cash on your balance sheet 2 years from now. So let's assume that our balance sheet structure does change exactly as we want to, and let's look at how that would impact both our earnings and risk. Again, we do what we need to for the regulators, but let's really use this information to monitor and drive where we're going. The last little point on here is probably controversial, but it's one that I've seen, and as I was in my last couple of years at the bank before we were acquired, we were really talking about, is we as commercial entities tend to throw out 30 to 60-day free rate locks on our CRE loans. And we're starting to see volatility, and let's think about how that can work against you. So there's kind of three options. Rates stay the same and you work out fine. But you go a 60-day free lock and rates jump, and they have done that recently, jump 20 basis points in that 60 days. You're not going to have an accounting loss, but you will have an economic loss. Your lender or your borrower is going to close that loan. And if you're using market-based pricing, you're closing at a rate that could be 20, 25 basis points less than what a current market rate is. And with the kind of margins and yields that we're talking, that's a lot to give up. Why do we say it always works against you? Well, if rates go down, you're probably not going to win by that 20 or 25 basis points. Your good borrower is either going to go somewhere else if you don't negotiate the rate, or just demand that you lower the rate even though you've committed. So it definitely is an asymmetrical risk. And so, we look since early August, which has been a few months now, the 10-year's up 45, almost 50 basis points now. So it really can happen even in a low rate environment. And you can be facing economic losses that will hurt you for several years, even though the accounting doesn't book it. So I just challenge you to have that discussion of whether we can lower or shorten that time period where we're exposed to changes in rates and we're just giving it away to our borrowers. On the funding side, you all have, or I would say the majority are probably sitting with excess funds. Let's understand what PPP has done to your deposits, how much it's inflated it. And that's easy to find probably. The hard part is how sticky are those. We've got to make some estimates and just kind of know what we can expect as runoff. You've probably heard from a lot of people to work on lowering your cost of funds, and I'm assuming the majority have lowered your rates fairly dramatically. We see it as an industry. But I would challenge you, look at those next steps. Realize if you can take a few more basis points out of your money market or savings accounts on a marginal cost basis, that really does help you by repricing an entire portfolio. Watch out for those one product customers that maybe you've made a special deal a year, 18 months ago when deposits were not so plentiful, and determine if that customer is really one you need to keep around. I can see paying up for a customer who's a full customer who has checking, savings, their commercial accounts. But if you've got somebody you're just negotiating rates up and they're a CD customer or one money market, this is the time to really think about whether that value is still there. I think most banks have set their tiers and their divisions of rates years and years ago and never really think about them. Maybe we need to do a stratification and determine if we can adjust tiers. Now, I know that retires or maybe requires some disclosures, but it's probably worth the effort. So say we are successful in running off some of those high cost non-core customers, even though they qualify as core. And so we've got to be ready to use wholesale funds. I'm just here to tell you, wholesale funds aren't bad. They're not always expensive. The FHLB rates, other ways of getting wholesale funds, a combination of those can allow you to lower your cost of funds. Our last year was 2015 before our merger closed, and we were 20 to 25% wholesale funded, and we had a cost of funds in the high 20s. Now, some of you with retail only may have been less than that, but there were a whole lot of banks out there that are retail only that were funding themselves at higher. And so being disciplined, using a combination of cheaper wholesale and aggressively marking your retail deposits can reducing your cost of funds. And the more you can do that, even basis points here and there, it allows you efficiency that allows you to compete. One other thought I would have is don't forget about your earnings credit rate. I know we had some where we worked deals with people and, we just said, well, if you keep X, we won't charge you. And we may need to rethink that. Now, if you make commitments are commitments. But that's another area, while it won't affect your margin, may affect your fee income if you are keeping your earnings credit rate at abnormally high rates in this environment. Finally, look forward. I've heard a few that said, well, I think we're going to go back to the lows. And we could. I don't have a clue. But let's look at what we have, not what might be. And don't miss out on good opportunities because we're looking backwards at what might be in the future. So that takes us through some of the tactics. So let's talk strategies. First thing I would say is big picture. We think there are two important overriding principles for success. One, if you meet your customers' demands, you get a better price. Amazon has proven that over and over. They live on pretty small margins, but they can get decent, good prices because they meet customers' needs. Apple is the best probably example of that, of who would have thought a few years ago we'd pay $1,000 for a phone. Well, we do it because they've convinced us that we need things that we didn't even know we needed. And when they do that and we meet the customer demands, and sometimes we suggest to them what they may want, we're going to get a better price. We're not just competing with a commodity product that they can go get on the street and they're just using you as a place to get another competitive bid and go with the best price. The second thing is we don't think the best way to manage your interest rate risk is using your customer base. That causes suboptimal results. And frankly, you are the paid professional to manage your interest rate risk. I think the best example of this is, I don't know how many years ago, the industry kind of decided 5-year balloons, ARMs, repricing, whatever you want to call it, were the ways to make CRE loans. Why do we do that? Because we decided that we could manage the rate risk for 5 years, and after that, we didn't want to. Well, what that means is longer term, we've asked our customer to manage the rate risk, and that's not their job. And so we believe you can offer them products that meet their needs, and you manage the risk on the back end, give them what they need. The other reality of that is if we're asking them to manage the interest rate risk, if we take the extreme example, and I'm not making a forecast, I don't believe it will happen, but if rates are up 200 basis points in 5 years, what we thought was debt service coverage and loan to values that were very acceptable in a new appraisal and cash flow environment may not be. So while we've controlled our rate risk, we've added to our credit risk, because we all know if we pass that rate risk on to our customer and he can't afford it, then we have a credit problem, and we've taken back the risk in a different way. So we're going to be talking about these concepts and ideas, but this is the big picture that it's all built around, is we get better prices, we meet our customer demands, give them what they need, and we manage the interest rate risk on the back end. So let's talk about loan hedging. We have seen dramatically increased volume in 2020. Why do we think it will continue in 2021? The first thing I will say is whenever I talk about loan hedging, I see people snarl, remember the old days of all the bad things that happened, and those are very true memories. And what I would say is those are memories. It's been more than 10 years that those bad things were happening, that the big banks got us through all of the pain. We were able to learn from their mistakes, the adverse consequences that happened when borrowers were surprised or didn't understand what they were in for. The other things to remember is a low flat yield curve is a perfect environment for these. Number one, the flat yield curve, when you convert a long-term fixed rate asset to a short-term floater, you give up much less than you do if the yield curve is steeper. And so you're giving up very little of the front end from going from a fixed rate to a floater. And finally, if you made this loan at 8%, there's a lot of room for rates to go down. We are seeing a lot of loans in the threes, low fours. Rates can go down from here. I'm going to go out on a limb and say, unless we go massively negative, which I don't think we will, we're not going to go down 200 and 300 basis points on these loans. Those concerns about prepayment risks that are embedded in these are much less when you're in a low rate environment. And we are very careful to document the risk and reward of these so that the customer understands what is happening. So liquidity is plentiful. You can turn these into floating assets. You don't increase your interest rate risk. And very importantly, in August 2017, FASB changed the rules of derivative accounting. And I can just say, there is no reason to worry about the accounting. It is so much simpler in the past. The negative consequences aren't there. And we or whoever you work with will take care of the documentation. There's just absolutely no reason to use accounting as a reason not to be investigating this. On the flip side, most bankers I talk with say, okay, we have to do these long-term fixed rate loans. We can't afford to take the rate risk, so we need to use swaps. We're going to hold our nose and do it. And what I would say in there is there's not really the case. You need to realize there's some positives out of this. One is just like you want to increase the average life of your deposits to increase your core values and your franchise value, increasing the average life of your loans by going to 10, 12, 15 years on a floating rate increases the value of your institution. It increases your chances to cross-sell. The relationship will be longer. So all of those things make it more profitable over the long term. After 5 years, you don't have to worry about potentially a new committee meeting, new appraisals, credit underwriting. All those expenses up front of making a loan don't happen again for years down the road. It will just increase your profitability, I would say, fairly dramatically to help offset some of that margin compression. And as I mentioned before, you take away a lot of that rising rate with balloon risk, so you will help your credit risk. And again, staying with the concept, you can compete with larger institutions, and you can meet your customers' needs. So let's look at a real life example. This was priced as of about 10 days ago. We were preparing the slides. So one of your existing borrowers comes up to you and says, I would like a 10-year fixed rate loan with 25-year AM, and somebody's offering me 3.5%. Will you match it? And so you can use LIBOR, Fed funds, prime. We've shown here effective Fed funds plus 260 would be your pricing. That also includes 20 basis points of upfront fee income, and I will talk about that in just a second. So this is, I think, the only bit of commercial I would give you. So if you'll bear with me for a minute or so, we use a thing called a smart loan that is like the back-to-back as far as economics, and we'll do one or two back-to-backs every year. We believe the advantage of the smart loan is that your customer does not have to sign an ISDA. They don't have to be an eligible contract participant. They deal only with you. As their lender, they make one fixed payment every month. So this is the product I used at our little bank, and I'm going to go back to nobody's too small. We were a $100 million bank when we started doing these. We were about 4 years old. And when we sold our bank, we were about 160 million, and we had about 16 to 18 million dollars of these on our books. Some customers didn't want them. For those, we made a 5-year balloon. For the others that did, and that overwhelmingly our customers did want them, they liked the fact that we were offering them a fixed rate loan, and it had prepayment language that we fully explained, and we gave them a matrix of how it worked. And so they didn't have to understand swaps and derivatives. And in fact, our president early on said we weren't used to that, using that word with our loan customers. They typically knew and would ask if we were doing a swap, and the answer was yes. We didn't try to hide it, but they didn't have to understand all that. All they had to do was they had a fixed rate loan for the term they wanted, but there was market prepayment language that we explained to them. As I mentioned, the fee income on this loan would be a little less than $20,000. And so if we did 20 million of these, we have roughly $400,000 of fee income, which is paid by us as your counterparty, not the customer, and it is taken directly into non-interest income. So it helps your non-interest income to offset the margin compression that you're facing. Just a little graph here of the back-to-back swap works fine, traditionally done by the big banks, done by some community banks. Nothing wrong with it at all, except it is complex. We believe the smart loan, which gives you all of the same economics, gives you good accounting, but is much simpler, just gives you another option to deal with small borrowers. You know, as we were a small bank competing, we kind of had a slogan that because we were smaller didn't mean we were dumber. That we're smart and compete with big banks. I feel the same way about our borrowers. You know, I ask all the time, are they sophisticated enough? And my answer is, your borrower understands contracts. They understand that you are making a long-term contract with them. You're giving them their best rate that you have to offer, and you are meeting their needs. And if they decide to back out of that contract, there's a potential cost. We found overwhelmingly that our customers understood that, and it was very explainable, and that they didn't have to be, quote, sophisticated. They just had to understand how the deal worked, and we explained it to them fully. So here, box and arrows, you will see this in every derivative swaps presentation. Your customer pays you the $350. You and I, as a counterparty, will swap the $350 versus your floating rate, in this case, effective Fed funds plus 260. The reality is we will do one wire to transfer that once a month. As you can see, there's no arrows between your borrower and us. We are just not seen by them. So you deal with your borrower. Fee income, we've talked about that. It's paid from us. And one of the beauties of it is, as I mentioned, you don't give up a lot as you go from fixed to variable. In this case, Fed funds plus effective Fed funds is now running about 8 basis points. So say 268, let's round it to 270 versus 350. You're giving up 80 basis points on day one. Your fee income will offset at least the first 2 years of that lost margin when you look at total cumulative income. So over those 2 years, you're going to make about as much money as if you had the fixed rate loan. And then after that, you will have a pure floater. Again, one of the benefits is you can choose the index, the AM, the structure, the payment frequency, your credit, all of that is yours. We don't get involved with it. The last thing I want to mention in this that I think is very underutilized, we had a customer just quoting on one of these this morning where they're doing a construction loan with a customer. So they're going to do, in this case, it was 2 years. So it's a big construction, but it could be a year, 18 months, whatever you need. You're going to charge them prime or whatever your normal construction term is. We're not involved in that. But you will lock in their long-term fixed rate loan today or when you close the loan so that they know what it's going to be in 2 years. In this case, we were quoting. So your customer has the regular construction loan, you deal with them, you do all the draws, but they know in 2 years when it's finished, they have their fixed rate loan and they know today what it is. That allows them to take advantage of this low rate market, this flat yield curve. And in the case we quoted both that this loan would have started today versus 2 years, and the difference was less than 15 basis points. So your customer gets a good rate. They know exactly what their cash flows needs are. From your perspective, why would you do it? You've taken the rate risk out because you're turning them into that floater. You're doing the swap today. You have your credit risk that you have anyway. But what you do is you lock your customer in. The most frustrating thing in our little bank was if we did a construction loan, maybe others didn't want to do it. And then they were worried about the construction risk, all the monitoring, all that goes with the construction loan. So we went through all of that. The loan, say it's for a strip center, it's completely leased up. It's an A property. Everybody in the world wants to make that fixed rate loan. And we found ourselves having to just go out and compete all over on price, even if we would offer long term. By doing this, we've locked our customer in. There's minimal cost. They are happy that they know what their rate will be, and you're happy that you know that you have this loan as a permanent. You say, well, what if it doesn't work out and the construction's a problem? Well, you're the lender of last resort if it doesn't work anyway. You're going to have the credit risk already, so I don't think you're adding to a lot of your risk by taking that and doing it now, but you are definitely giving your customers something they want. I'm going to talk briefly about loan portfolio hedging. You know, a lot of you are making mortgage loans. Some of you keep it in your portfolio. Some are living off the fee income right now, and I understand that. You may want to think about, and again, do some modeling. What if I hedge some of my existing mortgage loans? Or what if I add to this portfolio? Maybe I keep part of them fixed rate because I can afford it from a rate risk perspective, but maybe I want to hedge a part of this portfolio. The accounting rules for the first time allow you to do that now. And you can take a portion of a closed portfolio, pick a number, $20 million of fixed rate 30-year or fixed rate 15-year mortgages, keep them on your books, and turn them into floating without involving the customer. Again, the flat yield curve limits the impact on your margin. And basically the big thing in the accounting rules is you use a last of layer approach. You estimate prepayments, and so your swap will decrease over time. And as we will be monitoring it, and if you need to adjust the swap, you can do that with no restatements. In the past, if you adjusted a swap, it created all kinds of accounting problems. That's no longer the case. So I encourage you to think about if you say long term, I'm getting X in fees up front to sell this. Well, how much would I make in margin over the next number of years if I funded it, when I've got a lot of cash that's earning me very little? And what's my payback period of getting that in margin? You can do that on your existing portfolio if you have one, and then add new loans without increasing your rate risk. It can be used for a commercial loan, MBS, CMBS portfolio. So I would encourage you, again, that involves modeling, looking at your risk and understanding it. Investments, I mentioned earlier, there's different curves on the taxable side, or taxable munis, or even tax-free munis. We believe today that's the best place to invest. And so I'm going to give one very conservative option. This is a Texas school bond, which are AAA. And so just your real advantage is to go out 15, 20 years, much longer than many financial institutions would be comfortable on a fixed rate, and you would hedge it to the call date. In this particular case, I'm just using a 9-year final. It's offered at a 194 yield, and it has price vol up 300 of negative 25%. By swapping that, we can go to effective Fed funds plus 125. So you can see we're giving up roughly 60 basis points. But we take the price volatility from negative 25% to negative 2.5%. Now, this is, again, a very conservative approach. We've seen many customers that go out to the call date of 13 to 15 years, and they're able to get LIBOR plus 200 or more on those kind. Their plan is they're going to have written this down to par. Generally, these are pretty high premiums, high coupons, and probably they will write it down to par to the call date, and then they will look at selling it and closing the swap. They are taking some market risk, but generally speaking, if you've got a fairly short 5-6 years tail and you've written it down to par, you're taking limited market risk. We've had a lot of banks take advantage of the combination of this steep yield curve. The beauty of this is the accounting for the swap is that it runs through comprehensive income. So as your bond is losing value in a rising rate environment, your swap will be gaining value that closely offsets it. And again, tax-free, you're going to have better mark-to-market performance than in a taxable bond. Here are the numbers that I just went over. So you would get the current floating yield of 133. So this again was a floating to LIBOR, to effective Fed funds. You are giving up about $6,000 of interest income to protect almost $250,000 of potential market value in an extreme rising rate environment. I'm not going to go through the boxes and arrows, but it's there when you have the presentation if you'd like to do that. Last item I want to talk about is funding opportunities. Now, a lot of you are saying, what do I need to talk about funding and running out my ears? But just as a reminder, wholesale funds can help you and allow you to be more aggressive in marking down and dealing with your customers. So in our example here today, what I want you to do is really focus here. And this changes every day, but compare if you borrow short and then use an interest rate swap to lock in a term, what your savings will be. So let's just take a 5-year term. If you use the LIBOR swap, you will have locked in a pay fixed rate of 56 basis points. If you borrow from the FHLB New York, that rate would be 76 basis points. Now, we did not adjust for the dividend impact, but talking with Tom, say it's roughly 20 basis points. You're going to get that savings either way. So if you adjust for the 20 basis points, then your net borrowing cost from the FHLB is 56. We're using a swap is 36 because borrowing from the FHLB, you're going to take the stock. And then just as a comparative, you have the brokered CD. That is cheaper on a pure rate basis, but it should be. You don't have the stock. You've got to go through a whole issuance. It takes generally 10 days to a couple of weeks to get your money, a lot more work to roll over. So there's a price to pay for getting a little bit cheaper. So I think all in all, the FHLB, Tom and I have a several-year relationship. I love the Federal Home Loan Bank of Atlanta. I used them for years. I went to 2 institutions where they were not approved, and that was one of my first acts. So I believe in the FHLB of having them there for funding, both as a secondary funding source and then as a primary wholesale source. So how does the math work? You pay, and we'll go here, you would borrow from them for 3 months. You're going to pay them the 33 basis points. You're going to pay my rate of the 56 basis points. And then you're going to receive 3-month LIBOR, which when we did this is 21 basis points. So your net funding cost for the first 3 months is 68 basis points versus the 5-year rate of 76 basis points on a direct. Now that's not a lot. If you go longer, the spreads get wider. But I will say even for 10 basis points-ish in this market, is saving 10 basis points on every transaction to do worth it. I think it's a great thing to think about in this declining margin that we're going to be fighting for every basis point. So what you're really going to have is the 56 basis point fixed, you know that number, plus or minus the difference between 3-month advance and the 3-month LIBOR. Say 12 basis points today, that will probably change over time between 10, 12, 8. So you know you're going to be plus or minus a few basis points of the 56 or the 68. Here are the boxes and arrows again. I'm not going to go through that. The last thing in this section is a forward trade. I think this is a highly underused area, once again, where you don't need funding today. We've had several clients do this. This is one from a couple of weeks ago where they locked in $10 million of funding to start 2 years from now. So they went out 7 years, so they've locked in 5-year funding at 67.5 basis points. The 7-year rate, I think on the FHLB was 75 basis points today. And so they are locking in cheap funding at a time they don't need it. So they know in 2 years they're going to borrow from someone, brokered CDs, FHLB, whatever source is out there is the cheapest. They're going to roll it every 3 months, and they've locked in this pay fixed cost. I think this is a great tool to be thinking about today. How many of us after 2015, 2016 said, man, I know it would have hurt me at the time, but I really wish I had some of that cheap. This keeps it from hurting you now, and it allows you the chance to lock in cheap money when you have low rates and a flat yield curve. So this is one of the few areas where a flat yield curve helps you. I would really encourage you to use that, and I just realized I gave a bad number. The 7-year rate for the FHLB is 106 today. The pay fixed at 7 years is 75. So you're going out and locking in the 5-year funding. And today that 67.5 is a little old, but it would be about in the 80 basis point range. So you're paying up a little bit over what that rate would be, but you're locking in a term for 7 years, which will be 5 years of funding. The other beauty of this is you enter a swap today. If and when rates go up, you start recording an increase in your OCI your other comprehensive income because the swap increases in value even before you've done any funding. I would also, these are just different areas you can use it. Any of you that have trust preferred securities that are floating, you're enjoying it right now as a low rate. I would just mention in passing, look at fixing that either now or doing a forward swap on that too, and looking at the ability to lock in really cheap funding for 5 to 10 years and take advantage of this low flat yield curve to lock in your capital cost. And most of our banks have been able to do it in the 3s, which is an incredible cost of capital. Last thing I'm going to talk about is wire swaps of value now. I didn't use the words, but I found in my entire career the treasurer's dilemma. When rates are high and I wanted to go out into the wholesale world and invest, I didn't have any funds because loans were going great. When rates are low now, like they are now, I had more liquidity than I could want. Investments were unattractive, and I'd looked at low rates on the wholesale funds and I couldn't come up with a way to borrow them. Using efficient interest rate swaps can let you do all of those. Use your liquidity, invest it without taking rate risk, lock in wholesale funds in the future, and remember that those horror stories of the past are in the past. Now we see about 25% of community institutions are using swaps. The accounting is no longer to be worried about. These tools can help you. The last few slides in here are interest rate swap information. That's just if you want to look through it with your ALCO or your management team, and then our contact information will be at the end. So with that, Tom, I think we have a few minutes here.
All right, thanks, Tommy.
I'll turn it back over to you.
Sure. Yeah, I really appreciate all the information. We have a couple of questions. We're running a little short on time, but one question that we had was the cost of engaging in interest rate swaps. Are there any exchange costs or other costs just to get the ball rolling when you want to start doing swaps?
Okay, that's a great question. I will say different providers work different ways. In our case, we work with you to set up an ISDA and all the documents that are required, and we do not charge any fees. We don't have a retainer. So I can only speak for us. So there is what I would call in quotes a cost. There will be time. We will give you some policies. You'll have to do some board resolutions. You're going to have to review an ISDA, go through ALCO and your board to set up some things. Make sure you're trained and understand the risk and reward. So I look at it as any new product. I remember years ago when we added remote deposit for our commercial customers, or we did instant issue debit cards. Well, there was a cost, but we also had time. In this case, it's your time. So it's not going to take hours. It will take a few hours, and it will take some weeks probably to go through your processes, but there are no really upfront costs for us to work with you as a counterparty or as to help you get involved in the swap market.
Okay, thanks, Tommy. And then last question. Do you see any regulatory pushback for smaller institutions engaging in derivatives? And also, this is my question, do you help credit unions get up and running utilizing derivatives? Because from our perspective, we don't see a lot of credit unions utilizing derivatives.
Okay, sure. Two good questions. Regulatory pushback, I've been around long enough that I will never guarantee that a specific regulator will not question you hard or really be involved in questioning you and your involvement in it. But my experience, and I think our experience of Vining Sparks interest rate products, is regulators ask, they want you to understand it, and then they look at your policies, and it generally goes fine. We have worked with some regulators to actually train them on the use of products. As I said, when at my bank, we started using them when we were $100 million. Every exam, we went through it. We had our documentation, and we never had a problem with it. We have done swaps with banks as small as $50 million. We've just not seen a lot of that. Your regulators have seen it. Now, credit unions are a little more difficult. The NCUA requires the credit union to get regulatory approval from them, and there are applications to be filled out. And so it is not, I'm just going to be honest, it's not a simple, easier transaction as it is with the bank because of the regulatory requirements. So I would not say it's impossible, but there are definitely more hurdles for a credit union to be involved in this just from the regulatory perspective.
All right, thanks, Tommy. So I just want to thank everyone for attending today. If you have any questions on any of these concepts, you see Tommy's contact information is in the back of this or on the screen right now in this presentation. We are going to send out a copy of the presentation and a recording of the session. If you did also have any questions on any of these concepts, you could also ask me. I'm pretty well versed with interest rate swaps, and then I can answer some of those questions as well. So thank you for attending. And as a last reminder, next Thursday, December 10th, we're going to have a webinar from 11 to 12 p.m. Then, like Adam had mentioned, it's going to be a fireside chat with our CEO. So it's going to be a year in review and then talk about what we can expect next year. So with that, thank you, everyone. And thanks again, Tommy. Really appreciate your participation in this.
Thank you, and great to talk with everybody, and I hope you all have a good afternoon.
Bye-bye now.